Hi, this is Randy Finney with Right Side of the Chart, and today is Monday, August 13th, 2018. In this video, I wanted to talk on the GDX trade. On Friday, I've suspended the stops on that trade, and that's something I've rarely done in the nearly 7 years of running Right Side of the Chart. I've modified stops and price targets before, and usually that's immediate. If I come in and say, well, we're going to change I'm going to change the price target from this to this, or the stop from this to this, but suspending a stop a handful of times, maybe 3 or 4 times in the past, if that. I've done that on the site. Now, personally, I've done it more than that on my own trades, but on the site, I try to keep those consistent. Now, the reason for it, we'll get into it into a second. I'm going to start out with just a quick overview on the currencies, on gold, GDX, and I'll talk on my thoughts and share what I think I'll go ahead and do with the official stop on that trade. And then after this video, you can make up your mind if you're in that trade or thinking about entering it, what you might want to do with your own stop. Because suggested stops are just that. They're suggested based on a lot of factors, the charts, where prices are at the time, the price targets on that trade. But everybody, at the end of the day, everybody uses different price targets. They all have different, loss allowances, stop allowances, things like that. So let's start out here with the dollar real quick. Now, when the dollar was up here testing, and this is, I'm sorry, I should say the euro US dollar pair. This is my preferred proxy for trading and charting the dollar. Maybe we'll look at the dollar index charts in a second here, but this chart pretty much tells us where the dollar is going because the euro is by far the largest component of the dollar. So, we've had this very well-defined support level, and when we were above that support level, you can see so many reactions here over the last few months. Reactions here, and I'll show you on the weekly chart in a second. It's even more significant when we go back more than just the 2 years that we're looking at here. So again, on a scale 1 to 10, this was right up there, close to a 10 on as far as how important a support level it is. And I had laid out at the time and told you, I believe I stated I even was leaning towards what I call a false breakdown washout scenario, where we'd break down and then reverse shortly afterwards. I still favor that. I still believe that's in play. Now, only time will tell if that is going to prove to be the case, because this is either the real deal breakdown, which I strongly don't believe that it is, but that's just my take, and I'm either going to be right or wrong on that. But by everything that I've seen and trading over the years, that is still, I highly favor that scenario that will reverse, and most likely it'll be sometime this week. Ideally, it would be a reversal today. So far, we have a little bit of reversal, but the day is young. We don't have a green close yet on this candle. You can see that the pair is up, meaning the euro against the dollar. This is up about 1/4%. On the day so far. So there was Friday's move down, Sunday, the currency was trading. You have a candle there, and then today so far. So again, a lot of work to be done. We need to reclaim this level and reclaim it with conviction about the 1.154, 1.155 area, somewhere around there. And then to seal the deal would be a breakout above this downtrend line. I think that would have, and this would have, by the way, not just short term, but intermediate to longer term bullish implications for the euro, i.e., bearish implications for the dollar, which in turn means bullish implications for gold. Again, if that plays out, I'm talking a recovery clearly back above this line here. These two, it's actually a support zone. I have two lines in close proximity, and then that downtrend line. So there it is. Strong divergences on the daily chart, and we'll go to the weekly real quick. This is the bigger picture, and this goes into my analysis every bit, if not more so, than what I just showed you on the daily chart. What we have here is a chart, 10-year weekly chart of the euro US dollar pair. You can see it moving down here. Actually, yeah, it's about 10 years. What we had is back in early 2017, late 2016, right there, we had a divergent low, clear bullish divergences that set the trend bullish when we had a breakout at this point. Going back for years, I had been highlighting this, what I called a basing pattern, or basing bottoming pattern, or basing range. It was 1, 2, 3, 2.5 years long, and we broke out, and that was very bullish to break out of such a long-term basing pattern. We came in and we back tested it in late 2017. We back tested again recently, and what I've done on this chart is I added a second line. If you looked at the previous charts, you would have seen just this first line here. But when you zoom in, you can see why I added a second line. You can see a lot of reactions capped around that lower line, around 113.5 or so, 1.135. There's the quite a few levels there, so it's more of a support zone. And again, it also plays into that potential false breakdown scenario where we break down. More shorts pile in on the euro, more longs go in on the dollar, and then you reverse. And again, because these are long-term charts, if this holds, if we can reverse soon, then that sets the stage, in my opinion, for a much larger rally. And therefore, the price targets, or the potential in gold and GDX, is a lot larger than those targets that I currently have on the 60-minute chart. And I very well may expand those targets. And that's also one reason I'm willing to give some room on the stop. And the only other thing I'll mention here is, again, we're looking at 10 years of price history. You can see what happened in the past decade, every time that the euro-US dollar pair was oversold. What I'm doing, I'm circling this. The blue line here is the oversold level, 30 level, and these are substantial rallies. Again, it's a weekly chart. Don't underestimate how much it went up here, the pair. We had a persistent. This was the end of really a bloodbath type sell-off in the euro. So we did have persistent. We had two, and here's one oversold reading that didn't pan out. And I want to point that out. That's important to say that nothing's 100%. There was an oversold reading. Yeah, it led to a little bounce there, and it was probably substantial, and it would have led to a nice kickback rally in gold most likely. But we stayed oversold, became even more oversold, and then boom, that marked the end of that sell-off, and we had a nice push up, and then that began this sideways range. We didn't hit oversold again until this point here. So what I'm doing, if you look at the circles, 1, 2, 3, 4, 5, 6, now 7 so far of the previous 6. Let's just not even say, because we won't know until in hindsight what'll happen here. But of those 6, 5 of the 6 were excellent times to go long the euro, short the dollar, which again would have benefited gold. And at this point here, we had a positive divergence, and that's at the stage. And this also keeps me longer term bullish. That's a big multi-year divergent low, big powerful divergences. And yes, we had a divergent high here. I pointed that out at the time. And that divergence, as I mentioned, has played out. So there it is. There's the bearish rising wedge, and it brought us back to, once again, for another test of that level. So again, it all comes back to this. If we reverse here soon, ideally this week, be great to see it by tomorrow. That'd be a pretty big move. I don't know if it's going to happen tomorrow, but anything is possible. Wouldn't surprise me, but I'd like to see us close up on or above that level by the end of the week, and that's why I'm giving my position a little more room. All right, so enough on that. I don't think I can overemphasize the importance of the direction of the dollar with the price of gold. That's why I spent so much time on that chart. So here it is on gold. Similar story. This is a gold daily chart via GLD, the ETF. And as I mentioned, this is a key level back here. There's a big old gap. A lot of reactions there. And there's that potential flush out move, but we still have the bullish divergence in place right now. So nothing technically has changed, although we do have a break of support. And so you want to take it on face value, that's bearish for gold. You want to look at it the way I'm looking at it. This has a potential, and I think the risk reward is worth it. If it doesn't, start to gain some traction, reverse soon, then we throw the trade away. But if we do get a bear trap in gold, bear trap is when you break support, bears pile in, you get more shorts, long squeeze out, and we reverse, and gold is just right at that downtrend line. We had a little false break, it looks like recently. It's not a super well-defined downtrend line, but that's what I'm watching. So again, they will coincide. If we snap back above that level on the euro US dollar pair I was just talking about, we're going to snap back above this key 114-ish level on gold, and that would be pretty darn bullish in my opinion. And then just to look at the weekly chart, again, simple yet effective. This is 10-year weekly chart of gold. Gold was in a strong bull market up to 2011, so we didn't even see, at least through the period we're looking at here from '08 to 2011, we didn't see any oversold readings, and it got so overbought that it took a while once the bear market started to become oversold. But we did. We became oversold here, and we had a bounce. We became oversold right here, there, and we had a nice bounce. And again, it may not look like much, but that was, I'm sure, probably double digit, maybe 10% or so bounce. Oversold, oversold, bounce. Oversold again, and all this was our 4 consecutive oversold readings that set up bullish divergence that set the stage for this bull market that we've had since late 2015, early 2016 in gold. It was a bull market. It was much more than 20% rally, and the trend is still up, as I pointed out in the videos recently. Since that bull market began, we've only become, if this is the beginning here, that bottom of the bear market, we were only oversold once, and that's a common trait in a bull market. To get oversold, the readings are pretty infrequent, meaning they're far apart, and they're fleeting. Usually you get that one and done. And so here we are, we're oversold, a little bit below that 30 level there. We're about 25 and change, almost 26 on the RSI. And again, here's a trend line on the weekly as well. So it all comes together. Either this will be a false breakdown, which I suspect it will, or not. And if it's not, then gold's going to continue lower and probably a lot lower. And maybe this will become one of these persistently oversold readings like this. Possible. I really don't think so. And that's again why I'm giving this trade a little room. All right, so now let's just get down to the trade itself, GDX. As a weekly chart, not a super well defined. Neither of these trend lines are really that well defined. You can draw a trend line here, you can do that, you can draw this one, you can draw one from here, but you don't have a lot of reactions. As you can see, you have a reaction there and a reaction there. But bottom line is GDX is, if we look at the indicators down below, here we are, we're at oversold readings for the first time in GDX since down here. And that oversold reading was an extension of the previous divergence. We had positive divergence right there, and that led to a rally right there of, I'm going to measure it out for you, in pretty short order, about 157% in the gold mining stocks. One of the strongest rallies in decades, not just years. You can see the previous bull market, and you look at over such a short time period. So there it is. And when you look at this chart, say what you want about GDX. We know, and again, this chart goes to the left here. The trend was up coming off from the left. We know that was a bull market. It was unarguable. You can go back for a long time. And we know this was a bear market. And so far, this has all the makings of an early stage of a bull market. We're still way, way above those lows back from in GDX. It was actually very early 2016 when we bought them. So there it is. And then the daily chart, we'll zoom in, and I've harped on this chart quite a bit. I mean, just tremendous amount of reactions here on this level. And again, it all plays in. Yes, we've broken it. So you want to take it on face value, go ahead, short GDX, sell your longs. That may prove to be the real deal. Trying to anticipate something that hasn't happened is pretty tough. And that's just, again, it's gut feel, experience, my read on the charts. But if we get that reversal and we move back above 2012, and again, it's going to coincide with gold regaining those levels I just showed you, as well as the euro-US dollar pair. If we do that, I'd still favor a move up here, at least to that $23 area. Now, from where we're at today, we're talking about a 15, 16% gain, and I could very easily, because of the longer term bullish implications, if we get that reversal, easily see a move up here to about that 25.60. That's really the top of this trading range, going back to from 2017 there. So that's about a 28% gain. And here's again what I'm talking about. You can see actually all these reactions. So if I box it in here, you can see we've had a lot of reactions, and that would be, again, a potential longer-term swing target. And the bottom line is trading is all about risk and return, looking at, objective ratios. So if you're, we went long somewhere right around here recently, around a 21.14, I think it was. That trades down less than 5%. And I'm just holding that on the 21.14 mark. So not from where we are, but just from where we entered. If we go up there, that's about a 21% or so upside. And I think that's, quite possible. And so therefore I was willing to give this one a little room. This was the previous stop. Our entry price was 21.14, right about here. If I can nail it, I have to grab right on. There it is, 21.14. So right now this trade's down about 5.11, well, about 5%. Um, and the suggested beta adjusted position size, if I recall, was 0.7%. Now what that means is if you normally take $10,000, you temper this one down to $7,000. So therefore, you're really not at a 5% loss. You're at a net equivalent. Multiply 5% by 0.7%, and that's your your actual loss based on, compared to any other trade. In other words, when we beta adjust a position, take a smaller position size. And the upside potential, even to the official targets, is still within a somewhat favorable RR. It's about a little over 9%. So we're just under 2-to-1 R to R right now by allowing what we've allowed on this trade. And I've mentioned this in the past. We've had a lot of stops run on trades, unusual amount of stop raids in recent months. And so and on some of these trades, I've expanded my typical risk reward ratio beyond the 3-to-1 or better that I usually do. In some trades, I'm willing to take a 2-to-1 or even lower RR depending on my confidence of the trade and the potential if we get that. That's the thing about these failed breakdowns. As I often say, fewer things in trading and investing are more bullish than a failed breakdown, for the reasons that you have the shorts that jump in, they get squeezed when the reversal happens, they have to cover, they see they were wrong. You get longs that pile back in once that level is regained. So what I'll do is I'll put this video is going to go out and I'll make the official trade. This may not happen. It may get stopped out. So I'm going to say that now, but I'm going to just say that we'll look at the lows of the day, and you'll have to head into the close today. It's up to you if you want to close this one before the close, but the official trade, I will look to see today's lows. If we get a good intraday reversal some point today and we're heading into the close, I may give a hard number. Otherwise, I'm just going to say after today, the stop on this trade will be today's lows. And what that means, if GDX sells off into the lows, that low will be the stop, and that'll effectively take place tomorrow if we trade below that stop. Probably make it on a closing basis as well. This is right now we're in that final capitulation type sell-off where they just puke up. All the shareholders puke up. The last of longs can't take it anymore. Shorts get excited and giddy. Those I don't know who would be shorting it at this level, but again, I shouldn't say that. From a pure TA point of view, it's objective, not on here, but on that daily chart, because we broke support and the euro, US dollar, gold, everything broke support. But again, it's not not the type of breakout that I would short. In fact, as I've mentioned, it's the type I would go long on because I think it's going to likely be reversed. And another positive sign would obviously be a break above this downtrend line. So really what you want to see near term if you're watching GDX or if you're in this one, if we recover, there's a little gap to be backfilled. But if we get back above where we closed last week on Friday, back above this level here, that's going to be your first bullish sign. Actually, I should say your first bullish sign will be a pretty big, any nice big green candles, especially if they're bullish engulfing candles. On the 60-minute chart, better if you get it on the daily time frame. And then again, so that would be, buy signal number one, buy signal number two, reversal above, backfill, taking out that gap, backfilling it, and then some, and then a break of this downtrend line. And of course, you want to see that not just on GDX, but you want to see the same things happen on gold and the euro and the US dollar. You want to see these recent moves faded. And so we'll wrap it up here. So as of now, I'm in wait and see mode throughout today. I'll put this video out there, conveyed my thoughts right now that I'm not doing anything on GDX today. That's up to you. A 5% loss on a 7/10, position size. It's almost, it's 30% below a normal position size. To me, that's well within my loss parameters and risk parameters, especially considering the upside potential that this is a current target now, but I very well, if we get that reversal, especially after everything that's happened since I put this on, the fact that false break or that flush out move did pan out or has started to play out. I have to clarify that. We haven't yet finalized it with the reversal, but if we do, that even changes things. That makes me even more bullish intermediate to longer term if we can reverse in the dollar, in GDX, and the euro and gold, and clearly and impulsively take back those levels, then I very well may extend these targets here and allow this to morph into a longer term trade. But for now, we'll watch those levels, and any updates, if I see anything such as a reversal in GDX today, I may put out another post with a stop under X, whatever that level is, whatever certain level is. Otherwise, we'll just keep it as a stop under today's lows anytime going forward after today. And as of now, I'm going to do that on a daily closing basis as well. All right, this has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.